Everybody, and here we are back for our final session of the Sustainability and Banking Day to discuss the rising challenges that central banks face. We have quite an unusual situation in Europe. We have had several years of quantitative easing. We have had a lot more discussion about climate change and how that might affect financial stability. We had a whole session earlier today about climate stress testing and what's happening with the methodologies and approaches and discussing all the multiple issues with data. And this afternoon we thought that it is very appropriate to close today talking about what different priorities, challenges are faced by central banks and supervisory authorities. And to do that, we have some of the most interesting thinkers in this space, people coming from very different institutions and different parts of the ecosystem and different countries. So today with us, we will actually start with Mr. Fernando Restoy. He is the chair of the Financial Stability Institute at the Bank for International Settlements, which is, as we call it, the Central Bankers Bank. So it will be very exciting to hear what Mr. Restoy has prepared for us. So he will start us with a short presentation, and then with my fellow panelists, who I will introduce later one by one, we will actually dig deeper and unpack the topic further. So thank you, and without any further delay, Mr. Restoy, the floor is yours.
Okay, many thanks. It's a real pleasure to participate in this Sustainable Finance Summit, where distinguished speakers are going to discuss highly relevant issues for the financial system in the current challenging environment. So thank you very much to the organizers for inviting me to this event. The organizers have asked me to focus on the implications of climate change for central banks' policies. I will focus my remarks on the role of central banks as prudential regulators. I'm sure that other angles will be covered in the subsequent panel discussion. There is, I think now, broad agreement that climate change is driven by human behavior and proceeding faster than expected. Climate developments pose potential challenges for nearly everybody, and most certainly for banks and the financial system. As we all know, our financial institutions are exposed to climate change mainly through two different sets of climate risk drivers. First, banks are exposed to physical risks. In particular, banks may suffer the economic cost and financial losses resulting from decreasing frequency of extreme weather events such as heat waves, floods, or wildfires, but also longer-term climate shifts like changes in precipitation, ocean acidification, and rising sea levels. And also, of course, there are indirect effects of climate change which are also relevant, like soil degradation and drought. Second, as jurisdictions seek to address climate change by reducing greenhouse gas emissions, their efforts may generate transition risks. And this is because economic disruption will stem from the cumulative effects of changes in governmental policies and in technology and consumer and investor behavior. And this in turn will erode the value of banks' credit exposures or the corresponding collateral. By and large, the climate-related risks faced by financial institutions broadly fall under the risk taxonomy used in prudential regulation. In particular, physical and transition risks manifest themselves in the form of credit, market, and liquidity risks. In addition, climate-related developments can increase operational risk by affecting business continuity and by giving rise to litigation and reputational losses. Given the impact of climate change on traditional risk categories, the case has been made that prudential policy needs to be adjusted to account for the impact of climate-related risk on the safety and soundness of financial institutions as part of the core mandate of supervisory authorities. That could be called the financial motivation for regulatory action. Moreover, this adjustment has often been presented as a contribution by prudential regulation to facilitate the transition to a more sustainable economy by providing incentives for a more climate-friendly allocation of financial resources. That could be called the economic motivation of regulatory action. The financial motivation presents substantial technical complexities that supervisors need to assess if only to avoid unintended consequences. For its part, the economic motivation may not be as straightforward as it may seem, given the substantial trade-offs involved in prudential policy. So let me now examine these two topics in greater detail. So let's start with the financial motivation. When considering possible regulatory adjustments, the first question is whether current rules already capture climate-related financial risk. If that, if that were not the case, of course, regulators will need to consider supplementary actions through modifications to Pillar 1 instruments, such as the risk weights used for the calculation of regulatory capital ratios, Pillar 2 requirements as part of the supervisory review processes, or Pillar 3 disclosure obligations. And indeed, the Basel Committee, as the international standard setting body for banks, has announced a roadmap to identify gaps in the Basel framework so that it can develop measures to address them. However, quantifying the potential impact of climate-related risk on banks' overall risk profile poses formidable challenges. First, physical risks may evolve over much longer time horizons than the 12-month time frame typically used to measure capital adequacy under the current Basel framework. And second, techniques used to translate climate scenarios into financial risks rely on a wide range of simplifying assumptions. The results of these projections are subject to uncertainties, including the unpredictable course of future wind technological developments and climate-related governmental policies. Those two complexities make it challenging to use standard Pillar 1 instruments, such as risk weights, as I said before, to address climate-related risks. Capital requirements are designed to ensure that banks have sufficient loss absorption capacity to cover losses in the face of unexpected developments. Thus, risk weights should be calibrated with implicit value at risk methodology. So the idea is to measure losses for specific exposures in continuous scenarios occurring with a predetermined probability over a specific time horizon. That means that, in principle, an adequate calibration of risk weights for climate-related risk exposures would require an estimate, at least a rough one, of the whole probability distribution of climate-related events and associated policy reactions. In addition, given the long time horizon of the relevant projections, one will need to ask how banks might respond to emerging risks in these scenarios. Because asking banks to set aside capital today to cover losses for risk that may only materialize long after the maturity of most of their current exposures, and only if their investment strategy remains unchanged over long time horizons, well, this does not sit well with the underlying construct of regulatory capital requirements. Supervisory action under Pillar 2 offers more possibilities to deal with climate-related risks. Authorities would actually use their supervisory review processes to assess firms' exposure to such risks and seek, within a reasonable period of time, changes in firms' approaches to identify, monitor, measure, and control those risks. That may well prove to be more helpful than direct capital requirements to mitigate the impact of climate-related risks on banks' financial position. Sectoral concentration limits could also be used under the Pillar 2 if deemed appropriate. Beyond this, if additional loss absorption capacity is considered necessary, the imposition of capital add-ons under Pillar 2 based on suitable scenario analysis and stress testing could be more effective than upward adjustments in risk weights under Pillar 1. Climate stress tests, I think we have been discussing that in this event earlier. Climate stress tests allow, at least theoretically, the potential impact on banks to be considered in the light of different scenarios that combine specific climate developments and actions taken by policymakers and the banks themselves. Those exercises can therefore facilitate the derivation of a scenario contingent impact estimates of both physical and transition risks on banks within an internally consistent framework. Supervisors can then use those exercises to require either management actions or additional loss absorption capacity or both. A number of supervisors are currently asking banks to prepare transition plans. In some cases, those plans incorporate strategies to adjust banks' exposure to specific scenarios made by the supervisors in such a way as not to compromise their solvency positions over the specified time horizon. On that basis, the supervisor could identify persistent and unjustified deviations from the plans that could be factored in the regular Pillar 2 assessments and eventually lead to capital add-ons. In any event, as a starting point for any prudential measures, granular taxonomies are needed to support the assessment of banks' vulnerabilities, especially for corporate exposure. Moreover, these assessments need to be based on comprehensive scenarios, including climate developments and the policy responses. In addition, the standardized regulatory returns need to be developed that contain sufficiently detailed information on the relevant climate-related risk exposure. Fortunately, the international community is already working to fill the current gaps in information and analysis. In particular, the network for the greening of the financial system, the NEFS, has developed a suite of plausible scenarios, and these are already in use by regulators to analyze the vulnerabilities of the supervised institutions. The Financial Stability Board has also made progress in developing guidance for climate-related disclosures, which is now being adopted in many jurisdictions. These efforts are complemented by initiatives such as the decision by the FRS Foundation to establish public financial disclosure standards on sustainability, in particular through the creation of the International Sustainability Standards Board. Those developments will certainly help regulators to adjust policy, in particular, to adapt their supervisory frameworks and the Pillar 2 in particular to the implications of climate-related financial data. Having said that, the same flexibility that makes the Pillar 2 framework such a powerful and effective approach may give rise to level playing field issues. The international guidance on the application of Pillar 2 to address climate-related financial risks would therefore be a highly welcome development. So, turning now to the economic motivation. Promoting a swift transition to more sustainable economy should be a primary objective of general governmental policies. It's true, however, that regulatory actions, such as the ones that we have been describing so far, aiming at addressing banks' climate-related risks, would also provide financial entities with incentives to reduce exposures to firms and sectors that are most vulnerable to physical and transition risks. Therefore, while not being its primary objective, prudential regulation could, at least in principle, help facilitate a distribution of credit flows across sectors in a way that could support the transition of the economy towards a less carbon-intensive productive structure. However, it remains quite uncertain how far prudential policies can contribute to that social goal by themselves, to contribute directly to that social goal by themselves. Moreover, complex trade-offs may be generated by too great an emphasis on prudential tools with a direct climate-related macroeconomic objective. First, while regulatory penalization of exposures to moreover subject to physical risk, such as extreme weather events, may have a clear microprudential rationale, this does not directly help to mitigate those risks or to smooth the transition to green economy. If anything, it may even exacerbate the impact of climate risk on unprotected firms and households by reducing their access to bank financing. With regard to transition risk, more stringent prudential requirements for exposure to agents holding significant amounts of stranded assets will strengthen banks' resilience. But at the same time, it will also reduce the availability of funding for firms and sectors with a relatively large carbon footprint. and this could possibly help with the required economic restructuring. However, the quantitative impact of current penalizing prudential requirements on the actual credit supply may not be that sufficient, maybe not that significant, unless it becomes really large. And if this were to be the case, the affected companies will become less capable of shifting to a more sustainable production process, thus hindering the transformation of the economy as a whole. That is why prudential actions aimed at penalizing firms and sectors that are dependent on fossil fuels might exacerbate transition risks by increasing the vulnerability of a potentially large and economically significant set of borrowers. In this light, there seems to be a limited scope to directly use prudential regulation to try to mitigate climate-related financial risk for the economy as a whole without generating frictions with its core financial stability objective. What about the green supporting factor? Well, applying a green supporting factor to elevate prudential requirements for green exposures so as to facilitate the transition is unlikely to mitigate frictions across policy objectives. By reducing capital requirements for green assets, the unexpected losses that could arise from those exposures will in principle be sufficiently covered by own resources. Being green does not mean to be riskless. Moreover, such an approach would also encourage the overvaluation of green assets in relation to their fundamentals. And these two factors would increase the risks for financial stability and also the scope for friction between the financial stability mandate of regulators and general policies aimed at favoring the transition to more climate-friendly economy. These trade-offs for prudential regulators are mainly associated with the treatment of transition risk, as we have said. But of course, they become much less significant if governments adopt a hands-on approach in shaping the transition to a more sustainable economy. Although it is certainly a complex endeavor, comprehensive and well-defined policy program containing the required mixture of taxes, subsidies, and public guarantees for different activities could not only facilitate the achievement of the climate targets, but also, very importantly, alleviate the transition risks. In this case, regulatory action would be far more likely to be closely aligned with the general climate-oriented policy goals. So let me now conclude. I think few now doubt the urgency of public policy action to address climate-related risks. In the area of financial regulation, it is now widely accepted that authorities need to thoroughly analyze the financial impact of climate change on firm safety and soundness, and to consider adjustments to the current prudential framework as warranted to protect the stability of the financial system. Achieving the right balance between disclosure obligations, supervisory action, and if needed, the adjustment of capital requirements will then be a key objective. At present, supervisory actions taken in the context of climate stress tests look somewhat more promising than adjusting formally the capital requirements associated to specific exposures as a function of estimated physical transition risk. This Pillar 2 approach would, however, require clear guidance at international level to avoid unwarranted discrepancies across banks and jurisdictions. But at the same time, it will not be appropriate to assign prudential authorities a dominant role in the direct public policy response to the climate emergency. This should be left to governments. Regulatory instruments have at most an uncertain impact on the actual transition path towards a more sustainable economy. Moreover, in delivering on their core mandate to preserve financial stability, prudential authorities need to consider trade-offs and adopt decisions that may not always be fully aligned with climate-related policy actions taken in other areas. So in short, I believe that the best contribution regulators can make to societal objectives on economic sustainability is precisely to adjust the prudential framework to the extent needed to rigorously incorporate the impact of climate-related risks on firms' safety and sound. So let me stop with that and also I thanking all of you for your attention.
Thank you very much, Mr. Stoy. I think you covered a lot of ground and you set the scene very well, also touching on a variety of issues there. And I think it's especially important to note your very strong message that central banks don't act alone, they act in an ecosystem. And the path to a more sustainable economy, often the main role should be the government, and it should be the policy alignment across the board. So, in light of what you have just said and all the issues that you have raised, there has been a lot more awareness about financial risks stemming from potential climate effects on a variety of businesses. But central banks need to deal with a lot of different priorities, and in different regions these priorities also differ depending on the structure of the economy, depending on the vulnerabilities. So actually with this I'd like to turn to Mr. Mora, the Deputy Governor at the Czech National Bank, who's with us today. So thank you very much for making the time. So I would actually like to ask you, since Czech Republic is geographically quite close to Ukraine, we have seen the horrible developments of the war in Ukraine, and we have also seen quite a worrying rise in inflation. So currently, central banks are really dealing with quite an unusual situation. So, what should be the priorities of the central banks in this current era of rising inflation and potential stagflation? And it would be very interesting to hear from you, what is the Czech National Bank doing and what are your priorities going forward?
Thank you, Linda. Thank you for inviting me. Thank you, Fernando, for your excellent presentation. I'm not so sure how well I will connect to my predecessor, because maybe this is also part of the choreography why you put me as first speaker after the presentation, because I really think that I for a long time have been thinking that central banks should stick to their main core business, which is monetary policy, price stability. And I think we went too far as central banks to talk and give, in my view, wrong impression about all the other issues, including climate change. I will explain. I know that this is a bit of a provocative statement, but I will try to explain it. First, the situation in which we are now after COVID, where we already saw the first inflationary pressures coming. This was very much aggravated by the situation in the Ukraine, especially in our region, including the Baltic states, from which some of you are coming. And I think this brought us, central banks, to think really hard about our mandate, and this brought us to our core mandate, which is combating inflation and introducing price stability, which is a big issue. It's a big issue in the Czech Republic. There are other reasons for why do we have this inflation, and we will not make it now a monetary policy seminar. I will answer to your question also related to climate change, but I would see at least three long-term trends which have an impact on inflation, one of which is, I call them 3 Ds, to remember it. One is Green Deal, or climate change, whatever you would call it. So this, in my view, will have consequences for relative prices, but also then for inflation. Then the other D is deglobalization, which certainly will will give its part to inflation as well. And the last one is demography, of which we thought as central bankers for a long time that this creates anti-inflationary pressures, but recently there were some thoughts bringing forward arguments that it probably creates inflation as well. So, and then we had all these other topics in the central banking community. By the way, you know, recently there is hardly any conference on climate change without a central bankers panel, and there is hardly any conference of central banking without a panel on climate change, which I think is really not good. I and I will tell you why. And there are other topics like social agenda, like gender, crypto, central bank digital currency, etc. I'm not saying that all these other topics are not important, but I really think that the way we approach them as central banks is really dangerous. And I will say you why. I think climate change will be a big, big topic, and it will create a lot of problems and it will create many difficult trade-offs. But many of these trade-offs will have political content, and I think they can be resolved only by those who have political legitimacy to resolve them, which is political leaders, and not unelected officials in central banks. And I think also that we give a completely wrong impression also to politicians and to our public when we speak about climate change, that we should be the responsible institution for combating it or changing it, which we are not, in my view. You know the slogan, no taxation without representation. I say sometimes no regulation without representation. So I think, and there I slightly disagree, but I know how Fernando meant it. And there I also have a dispute with my own section, which I supervise within the central bank, because one of the sections which I supervise is regulatory section, and I say always, we are not regulator. The central banks are not regulators. Regulators are the parliaments. They create the laws, and within the laws we are a bit of a regulator. I understand that, but we are mainly supervisor. But the rules, the main rules, are created by elected people, not by us. So, and there I say simply, we do not have the legitimacy to pretend that we are the regulator, and we do not certainly have the means and the political power and the legitimacy to deal with these possible trade-offs. By the way, 2 days ago, in a very important journal which we read as central bankers, which is called Central Banking, there was an article that central bankers face a trade-off between combating climate change and safeguarding energy security. Sorry, this is an important trade-off, but this is not for us. It's not for central bankers. I'm very sorry, and I think we created this wrong impression also by the way we talked about it. Point number one. Point number two, I think we simply do not have the knowledge. Enough knowledge is not our specialty. We should try to understand the risks and the consequences for financial stability, even maybe for monetary policy. But I think, as I said, sometimes we go too far, and here I have to bring the example which I always mention. We understand, I think, as central banks and maybe even as a mankind, that we should reduce the CO2 emissions and we should reduce the increase of temperature, etc. But I am not so sure if we really know what are the right means to that end. And in my view, electromobility is one of the very often mentioned examples. I am not convinced at all, but who am I as a central banker really to make such strong statement? But me as a citizen, Marek Mora, I'm really not convinced that electromobility is the right way to combat climate change. So knowledge is something which I think we lack as central bankers. Third, I think we do not have the instruments. Economists agree that the best instrument, if we should do something collectively, as a collective action, the best way would be taxation. And this is again something not for central banks. And last but not least, and we should not forget that, maybe and that's why I think we should be much more neutral about this topic. We should try to understand it, to study it, but we should not be normative at all. The reason is that maybe we as central bankers, even within the area of financial stability, we might be forced or challenged not to combat climate change, but maybe we will have to combat the green bubble, which might be created soon. We don't know. It's also, this whole thing is something which is now very, how should I say, sexy in the area of banking, and the young people like it. I have no problem with that, but maybe all that will lead us to something which could be something which I call a green bubble, and it might be that we will get into a situation as central bankers that we might not combat climate change, but combat green bubble created through all this marketing. So I would be much more neutral, much more skeptical about all that, the way how we approach it, the way how we speak about it, and I think we would be much better off as central bankers if we do that.
Thank you, Marek. I think that's a very, very good opening, because now we have also a bit of an overview of the main challenges there, because I think it's absolutely true. There are trends in society, and trends can, they can actually disappear, and then that can definitely create problems for actors in the system that need to remain calm and collected and keep their heads cool. So in that sense, absolutely. I think it's very interesting also that you mentioned the fact that there could be a green bubble that has not been discussed enough. I think we do need to discuss all the potential trade-offs that we face. And I think that's already happening a lot more because we have realized that there will be also a potential social impact, and that can create greater political risk and volatility. So these are things that also worry the investment community. So that is very key to understand for planning for the financial sector. So let me now turn to Santa Purgaile, the Financial and Capital Markets Commission's chairwoman from Latvia. Since I'm Latvian, it's a real pleasure to welcome another Latvian on a panel, quite unique, and another woman. So I was actually wanting to ask you, what kind of changes have you seen in the supervisory activities in Latvia? I know that from what I heard earlier, that you are actually getting integrated into the central bank. So it'd be lovely to hear from your perspective, what are the key issues that you are seeing that are changing, or the key challenges that the Baltics and especially Latvia is tackling?
Thank you, and nice to be here. Of course, as also Mr. Moore said, that as central banks are primarily tackling the monetary policy issues and the price stability, we as supervisors are tackling the stability of financial market, of the financial sector and the capital markets as well. And of course, we all know that for more than 2 years, we've been living in a constant, some kind of crisis situation. It was the pandemics. We were, into that, closely monitoring what's happening, what kind of industries might be affected. And now, of course, the recent developments with war in Ukraine, again, put another pressure on the banks and us as supervisors to closely monitor the situation and assess the asset quality in the banks and other financial market players. So, and of course, with that, we need to prioritize. And being the small country also with pretty small supervisory authority, we need to implement the risk-based approach when we assess the potential risks and when we deal with them. And definitely with the current situation, of course, we started with the proper monitoring how the portfolio quality, the asset quality might be affected by the war in the Ukraine, when the geopolitical risks coming in. Of course, the very, very important focus in this all also goes to the cybersecurity, because as we speak now, the DDoS attacks happened, and I just got the message that our webpage as the Financial Capital Market Commission today was attacked and was down for almost half an hour. So that's the consequences we see, and definitely those we are also having this dialogue with all banks and raising the awareness and really giving them the messages to strengthen the defense mechanisms to deal with the cyber risks evolving very, very much in the recent time. So again, when the whole Europe now is sort of engaged in how we can put the Russia's activity on some kind of controlled manner or make Russia suffer, we have implemented a bunch of different sanctions. There are packages coming in, and of course the banks are the front runners to implement the sanctions to control and avoid any many sanction evasions, and so this is the next priority as we speak. We need to supervise whether whole sector being properly dealing with the situation, with the sanctions. So again, and given that, definitely there are other inherent risks already banks possess and deal with. So definitely we understand that the sustainability and ESG as a risk and as a topic is evolving and will be the very major part of whole risk palette, if we say so. But again, now we are in some kind of warming up phase, and definitely before mentioned priorities, some kind of pushing a bit back the real sort of action towards the sustainability, and so I think this is the very, very challenging time. So trying to some kind of manage in all those risks and trying to understand which is more important when the situation comes, and how actually the financial sector, how resilient towards each of those risks are. So this is what we have on a plate now.
Thank you. I think it's a good expression, the palette of risks. So we don't face one, we face multiple. Some of them are a little bit more urgent. So I think it's very interesting to see how you mentioned, Marek, the fact that we need to understand. Education and understanding is absolutely key, but the action has to be quite careful, I guess, not to rush into something. So let me now turn to Martin Krivanek from KPMG, a director here in Czech Republic. So my question to you would be, since you have been working on the banking side as well, so what, in your opinion, is there more that can be done on the knowledge building on climate risk space to enable banks to be more effective actors on climate change?
First of all, I would like to thank you, Linda, for this opportunity and this great, inspiring conference, and thank you for having me here. I would say definitely yes. I explain also why. Climate risk is a relatively young risk. By definition, it's here, let's say, for the ages, but what is young here, it's that its materiality and its, let's say, view from the general public, from the institution, and from media. Now you can read about it everywhere. I think also a good example is here there are posters, and on the left there is a trajectory of correlation of function between CO2 emissions and global warming. And I think now we are living in an age where it's, I believe, confirmed and accepted by the public that most of, let's say, increase in CO2 is anthropogenic, and the relation between CO2 increase and temperature is confirmed that it's highly correlated. So we also probably can predict the trajectory up to 200 and to the end of the century. So now we are in the situation that the risk will emerge. And we are at the beginning. We start to, let's say, learn new approaches to the risk management. We already know that the climate risk has a lot of transmission channels. We understand this is more like transversal risk, which is, let's say, included in the traditional financial risks, like credit risk, market risk, operational risk. Also, we are learning how to let's say, transfer these risks, these transmission channels to traditional financial risks, to capital, turnover, and other stuff. So that's why I think we need to explore more this risk. And after we, let's say, dig in and learn how to manage the risk, how to gather information, this will become the traditional risk in the, let's say, in the central banks management, also in the supervision. That's why I think that central banks can do more, but it's not a criticism. It's like we need to explore more. Some central banks already started. I think good example is ECB, because they already introduced their 13 recommendations for risk management, and it's still beginning of the process. We see after 2 years, those are in actions. Still, there are a lot of banks who are fighting how to, let's say, work with these. We don't have the data. It's a topic for itself. I think we can discuss later how to approach the climate risk data. So I think central banks can definitely will focus in Pillar 2 in their supervisory role, in the supervisory review and evaluation process, in order to, let's say, push the banks. Also, they will discover the climate risks, report to the banks, and also there is a risk if it's the risk, let's say, of the assets are overpriced because of climate risk included, and some stranded assets will appear, or if it's a bubble, which is currently, let's say, we are blowing it up, we need to explore, and without tools, data and methodology, and also the public knowledge, it's hard to tackle. So I think if I, let's say, use some metaphor, it's not a newborn baby, but it's still infant, and we need to move to at least adult age, and this will take a couple of years. But the trajectory, I think, it's almost, let's say, exact for the next decades. And what is now everybody focused to, let's say, decarbonize, but what we know that duration of CO2 in the atmosphere is very long. So if everybody starts, let's say, breaking right now, definitely the effects maybe will be the next generations will find the effects. So next couple of decades will be very interesting.
Crucial. Yeah.
Yeah.
Thank you for that. I think it's very interesting that in every single discussion that we have, we end up with the issue of data. And there was this big hope that, you know, we will have so many more disclosure regulations, we will gather the data, age of big data, then we're going to create perfect algorithms and we will start understanding it better. But I guess we're still not there. We're still trying to figure out biodiversity and natural capital we haven't even touched upon. But if we think about the underlying fundamentals of the economy, it is a little bit worrying thinking that some business models will just collapse and some of them can be quite systematic effects across the board. Let me actually quickly turn back to Mr. Ristoy before we continue. So actually, in light of what we've just touched upon, I know that the Bank for International Settlements published quite an influential report, the Green Swan report on financial stability and central banking. So at this stage in time when we are really fighting inflation and we have a war, we have a variety of different very urgent issues to tackle, would you say that prioritizing climate change, isn't it arbitrary? Is it actually a prudent approach? Or do we need to keep that exploratory phase, to keep working on refining the methodology, gathering data before we act? Or what would be your response to this issue that we might be rushing into something we don't yet fully understand?
Yeah, Linda, thank you for the question. I enjoyed very much the interventions by my fellow panelists. I wish I would have been able actually to travel to the wonderful Prague and join you in person. But anyway, on your question, I think, of course, you are referring to this report that we published already a couple of years ago. A number of things have happened, not all of them for good, for sure. Certainly, the good development that you also stressed in your introductory remarks, Linda, is that there is much more awareness about the far-reaching implications of climate change. That's a very important development. Leveraging on that, you have seen also much progress at the technical level, particularly by the Financial Stability Board and other international standard setting bodies, just to put in place the information, the analytical framework that allows regulators, but also the firms themselves and markets, actually to adjust their strategies and modus operandi to the challenges posed by climate developments. And also it's clear that we have seen that political support for policies aiming at ensuring sustainability, this has also increased and actually reached jurisdictions whose governments were not particularly supportive only a couple of years ago. And as a consequence of that political support, we got COP26, quite a relevant agreement in which I think more than 150 countries, representing I think like 90% of global GDP and around 85% of greenhouse gas emissions, they decided actually to establish targets for 2030 that would imply a reduction of around 5 billion tons. So this is something which is there, it's a material, actually material progress in relation to this. Of course, the bad news, and now it comes the bad news is that this is by no means is enough. We know that this reduction in greenhouse gas emissions basically is not sufficient to put us in a trajectory towards the target of having only a 1.5 degree increase in temperature by 2050 is more consistent with a 2 degree increase, which we know is clearly insufficient to mitigate sufficiently the devastating impact of climate change. And of course, we have the war. I mean, you mentioned that, with all the far-reaching economic implications, including inflation. So the war certainly has disrupted a little bit, actually, the pace towards sustainability. I think also, I think was Marek referring to this before. We have seen how some countries are now deciding to try to replace gas imports by coal consumption, which is obviously even more polluting than gas. More importantly, what we have seen is that a number of jurisdictions are actually subsidizing oil derivatives and therefore get it into the business of of course, mitigating the impact of recent developments on consumers, but at the same time, of course, we are reducing the incentives for the economy as a whole, actually, to accelerate the reduction in dependence for fossil fuels. And this is certainly not a favorable development. I pretty much hope, and let me also go back to the issue that I think Marek as well referred to, which is this trade-off between energy security and sustainability. Of course, in the short term, we have seen some trade-offs, but pretty much hope that people, countries, governments are going to understand that over the medium term, there is no trade-off at all. It's something what we have seen and suffering in Ukraine because of the Russian invasion should actually provide additional and strong arguments in favor of sort of establishing the right policy in order to reduce dependence on fossil fuels, and by doing that, on energy imports from countries which are regularly subject to geopolitical tension. So if we internalize this, that could only help accelerating the pace towards actually achieving more sustainability by relying less on fossil fuels, and therefore going beyond the targets I mentioned before for greenhouse gas emissions. I think that pretty much hope that we are going to realize collectively this, and that over time, despite the short-term trade-offs, that what has happened actually would increase even more awareness and the determination actually just to implement the right policies to address the huge challenges posed by climate change.
Thank you, Mr. Stoy. I mean, it is a very interesting topic about the potential disruption in the system if we start having continuous extreme weather event and start seeing some sort of non-linear trajectory there, as you pointed out. If we start having a collapse of certain systems, how will that impact financial stability? I wanted just to quickly remind our audience, we do also have an option to ask questions that is on Slido, so sli.do, and there is a hashtag CEE Summit 2022. So if you enter that, you can just pop in a question and I will see it, so then I can put it to our panelists. So don't forget about that option. Take some agency. Maybe there's something that's on your mind, and then you can ask and we will try to answer. Let me now turn quickly to Santa and then afterwards to you, Marek. I was wondering actually, so we have the Czech National Bank that is not part of the Eurozone, and then we have Latvia that is. So how is that affecting actually the work on climate risk? How is it affecting all the work on inflation and financial stability in the country? Is it also useful to, for example, join the NGFS, the Network for Greening the Financial System? So what are the kind of channels that you find more useful in terms of gathering information and understanding the risks and developments and connecting with the other banks?
Of course, being a part of Eurozone, we see as the benefit, definitely. And again, for small countries as we are, and also all Baltic states, we do believe that being in the ecosystem where there's some kind of unified approaches are, and we can be also a part of all those groups, all those also supervisory entities, but on the other hand, actually, that gives us a lot of, freeing up the resources locally. We are just, the part of data gathering. We are part of policy making, and definitely, I think also in these turbulent times, this is very important that we can keep the stability as well. Of course, again, it's more the central bank's function, but we as the supervisors and regulators, the local national competent authority, definitely we see a lot of benefits. However, there is and some challenges, of course, that again about the proportionality, because of course when we look into the different kind of also regulations coming out and actions to be taken, we always need to consider the market size and the resources needed to implement in such a small markets. And that's why we are always stepping up in different EU level discussions, raising hand and saying, let's have some kind of proportionality when we implement things. So,
okay, that's very interesting in terms of the size of the country and size of the market. And I mean, it's also very tied up with the banking systems, just like here we have parent banks elsewhere, and it's quite similar in Latvia. So that is also affecting the scene. Let me turn to you, Marek. Actually, I wanted to ask a question that is related much more also to the financial stability from a slightly different angle. I was wondering, so we have had a prolonged period of quantitative easing that has created very interesting outcomes in terms of both wealth inequality and these expectations have been now set that, we just have quantitative easing and that's how it works. And we need to figure out how much do we raise the rates and how do we tackle the issues. But I was wondering, there's also been a very lively debate around cryptocurrencies and how much risk they can create. And we've had these conversations before. So is that something that also should be regulated or kept an eye on? Because the bigger it grows, it also has implications on the Ukraine situation. So what are your thoughts about that? I mean, it also has climate implications in the Bitcoin case. But what would be your thoughts about
Yeah,
that?
thank you for your question, Linda. May I just quickly react to my
It's
predecessor
very encouraged.
before
You don't
answering?
even need to wait for your turn. You can react whenever.
Okay, just...
And the same applies to you, Mr. Stoy. You can just raise your hand and you can just jump in.
Yeah, I hope I will not forget your question, but I have it somewhere written, so probably not. Just to explain to you, Sandra, to avoid any misunderstanding, we as a Czech National Bank, we are definitely a monetary policy authority, but we are also supervisor over the whole financial sector in the Czech Republic. We are responsible for financial stability, money circulation, the payment system, etc. We are also resolution authority in the Czech. So we have plenty of competencies. By the way, you learn in the world of central banks that each of us is a different animal. We are quite different, and we are one of those which have, quite a big concentration of powers. So it's not so that we are not. So part of our function is exactly what you are doing in Latvia, but we have an extra institution. But everything is integrated in the Czech case in the Czech National Bank. So it's not that but I still thought that the proportion between this whole climate change business, which I say is not unimportant compared to our core business, which inflation should be now a bit moved back to inflation. And then within the climate change, I really think that we should put much more emphasis on positive analysis, on data, knowledge, all these things, and really be much less outspoken about, normative statements, what should be, because I think we went there too far, also given, as I said before, the wrong impression to the public, but also to our politicians, because I think many politicians now think they should not do much about it. Let's deal, the central banks with this, which I think is very bad and very dangerous. Now, to Fernando's points on this trade-off between safeguarding energy security and combating climate change. First of all, as I said before, I'm not sure if it's really for central bankers, but if I should answer as a citizen, Marek Mora, I would say, given the talks which I heard in the Czech Republic, imagine that tomorrow we would switch off oil and gas deliveries to the Czech Republic, which hopefully will not happen, but you never know. And we now are talking in the European Union about the oil sanctions, not yet about gas. But imagine that in that moment, I really think that we would drop, at least in the short term, all these ideas about combating climate change. We would simply try to do everything we can do to manage to deliver energy, even with maybe dirty sources, but then over the time, I think we would get back to this trajectory of clean and green energy. So I think we would see a kind of a J curve, worsening of the situation, but improving it. But many people say that the Green Deal and greening the economy is part, actually, of our energy independency. But there again, please, it's not really, I'm not sure if I should say that as a central banker, but my knowledge is that I'm a bit afraid again that we say, okay, we should not be dependent on oil and gas on specific countries. But then, very similar countries are those where you have these rare metals, all these other things which you need to produce the batteries. I think we will create another sort of dependency. So I always want to think everything to the end before we make strong statements. But again, and sorry for repeating it 20 times, that I think it's not for me as a central banker to make such statements. Now, to your question, Linda. Financial stability, the war in Ukraine, cryptocurrency. So the war in Ukraine did not have any very direct consequences on the financial stability in the Czech Republic. We had an issue with one bank. By the way, the bank was named, its name is Sberbank. We had this issue in several countries everywhere where the Sberbank was active in the European Union. The reason was settled in the Czech Republic, but I think in the other parts of the EU as well, that basically the bank was healthy. It had no problems at all, but because of the political circumstances, etc., which I don't have to explain, we saw a run on bank, and even the healthiest bank would not survive a run on itself. So it was the case of Sberbank. All the rest of our banking system, financial system, is okay, despite we know the fact that we know that some of our parent companies had some exposure in Russia, but frankly, this exposure is not vital, and all of them will manage it, and it will be no problem. So in that sense, is no problem. What is a problem, however, is this indirect environment that we had a long period of low interest rates, which created, which had some, let's say, stabilizing reasons and consequences at time when it was used, but it also had some dangers in it, including, what we call zombification of real sector of companies, search for yields in the financial sector, so taking on the balance sheet some maybe riskier assets. And now, with the situation in the Ukraine and some other things which happened before, we saw changes in inflation. We see that the monetary policy will have to react. We see it. We have reacted a lot in the Czech Republic. We see that the Fed is going to react. We see maybe even the ECB will have to react, and maybe faster than people thought before. And this quick reaction, these changes in monetary policy could, of course, create disorderly adjustments in the financial sector, in the real economy, and this could have consequences, especially if Fed increases the interest rates quickly. It would have worldwide consequences on the financial sector, on the real economy, especially on those who have debts in US dollars. And we will see how much, how much consequences it will bring for us, and it could definitely create risks which we are not yet ready, or we are not seeing them very clearly. But I think there are some risks there as well. And now on the cryptocurrencies. Well, first of all, in the Czech Republic, it's not, it's the same, I would say, dimension of an issue like globally. These currencies do not have yet, I would say, a systematically important consequences, but the volumes are rising dramatically. And of course, if this continues, one day we might face the risk of a kind of systemic danger in using them. So that's why also we are looking at them very carefully, all of us, the supervisory community, the central banks, the BIS, the ECB, etc. We are now in the process of creating a regulation at the European level. So let's see how far this will bring us, but this is certainly something which we should watch very carefully. And if I should make a link to the Ukraine and to the war and to the sanctions, we can also see that this crypto world is probably used as one way of circumventing the sanctions. So we have this whole area of anti-money laundering, combating financing of terrorism, and all these things, which are also very important.
Yeah, thank you. That's a very comprehensive, quick overview. No, it's fantastic. I think it's also very interesting because I think we have woken up our audience, so we are starting to see questions flowing in, because I think we've touched on a few very interesting issues and conundrums that we have not yet solved and that we probably will need to dig into deeper. We do have a question that I'd like to pose to you, Martin, because I think you're well placed to tackle it. So one of our audience members is asking about agreeing that there's a lot more work needed to be done on data in the Czech Republic, and actually, especially on climate risk. And the question is, how would you imagine such an exercise taking place in the Czech Republic? So how could we actually start gathering this data, and whose responsibility is it?
Yes. I think it's a good question. Probably majority here has already practical experience. Non-financial data are very specific compared to the financial data, because in history we had a couple of exercises like Anacredit, where new package of financial data needs to be gathered and delivered, let's say, to central bank. And this was, let's say, task of not creating the data. It was just only about the management and putting together and doing some data quality checks. But regarding the non-financial data, a lot of these data, they do not exist at the moment. And like a good example is CO2 emissions. Firms need to calculate those emissions. There are already some firms who calculate these emissions for a couple of years, but this only typically scope 1 and scope 2, and scope 3 is missing, needs to be calculated. Also, it's question if it's complete, if even the number, if it's calculated, if it's complete, if some, I don't know, CO2 sources are not missing, and so on. There is no assurance above these data. It's already also planned after the new, let's say, reporting regimes, CSRD and taxonomy will be fully in action. The assurance will come after. That will definitely improve the quality of the data and so on. And another example is typical data for let's say physical risk is explicit location of the physical assets. It seems it will be a big topic for the next year. Also, I have seen some stress tests of central banks, like Hong Kong Central Bank did a stress test in last December, and they performed it on zip codes. I think in the previous session they already discussed the same, that it was in Oslo. So it's very rough definition. So we need to find also the GPS coordinates. Probably it could be also the issue of GDPR and the similar stuff. But this, let's say, finding of the new data and gathering, this may also help to finding a new information from that, and probably it can help also the scientific community to improve. And back to your answer, who should be responsible? It's also questionable. Definitely, we will need some repository of these non-financial data, because it's not efficient that everybody will be gathering these data by itself. If I was speaking about CO2, one firm has exposure to is exposure in multiple banks, so it's not necessary that it will be transferred multiple times. I know that there are already some NGFS is in touch with somebody with some projects that they already have some, let's say, startups of repositories. I think it will be to build some repository at the level of European Union, also some national repositories. Maybe the Ministry of Industry maybe probably build some repository, and also Czech Banking Association is building. So we need to align all these repositories and also the methodologies, the definition of the data. So some regulatory approach is necessary here, and to align all of that.
Yeah, it's a very good point about the very different methodologies. That's what creates a very big mess, and then it's very difficult to actually meaningfully use and analyze the data and actually integrate it. Sorry, Santa.
Yeah, I would love to intervene, as we are a lot of discussing data, the lack of data, and of course the importance of data. But again, I think if we are and we do have the ESG risks and ESG, all issues related to ESG and sustainability, of course, on our daily agenda. And as I said, it will become even more and more important on our agenda. But I think it's not just about the data, but I think very, very important to start to set those building blocks about, what do we mean by ESG? We have started with the sector, the financial sector, with the banks, those we call them green labs. We have open discussion platforms when we discuss actually what kind of expectations we do have, we as the supervisors and the financial institutions. We have set up our supervisory expectations, wrote down, and we have 9 points set. And those are, as I call it, like a building blocks. Where should we start? We should start with the naming sustainability and including sustainability into the strategy first. We need to appoint particular responsible person in each institution to tackle all those issues. Because if it is scattered all around, then the institution actually will not be like hands-on on those issues. And then definitely, of course, when you start like assessing each and every small step what you do on everyday basis, on your customers, on your processes, then you start to understand what kind of data actually you do have and what kind of data you lack. And then with that, those dialogues in between different society members, starting from like discussion about like, how we change our lifestyle with the private individuals, about the consumption, what should we consider, then about the businesses, how banks actually talk to their customers and how they intervene with different kind of, also value chains, different channels and different, approaches what kind of data they already have. And what I see that like raising the awareness, having those dialogues and openly discussing, we are sort of, I call those like building the very good foundation to build then some kind of regulation, guidelines, even maybe some technical standards on that. But if we do not have the overall awareness, what do we mean by ESG, then, we will be still, struggling and claiming we don't have data or we don't have that and that. And that's our also sort of our, experience, what we see. And we also started leading by example. We wrote down our, as a supervisory entity, our sustainability strategy. We reviewed our all procurement processes, the social aspect, how we treat our employees. So those are like small steps, but those are very important from our point of view. And I do believe that if everyone just starts to think firstly those small steps, then already we will make big step at the end of the day.
I think that's a very important message to send, that you start with yourself and you do start with incremental, smaller steps. It doesn't have to be perfect. And it's a very interesting point also that it's not in a silo. We've been trying to fight these silos also across the region. And it's actually very difficult because you have, as we discussed in one of the closed door sessions earlier, that you have different associations that work for this sector, but there's usually just the sectoral representatives, and you don't have a complete view of how actually these parts of the system interact and what you actually need from the banking side versus the business side versus policy side, regulatory, supervisory side. So we really need to start building also that dialogue from which you can start reaching some sort of an agreement. And that also acts as an awareness raising issue. Because I think a lot of these things, people don't really understand the interlinkages, or at LSE, its motto is to understand the root causes of things. And I think that's a very important thing, to actually understand these unintended consequences that you sometimes can have. And that cognitive diversity is very, very difficult to get if everybody's from the exact same sector. So I think that's a useful thing. So earlier today, we actually launched the Czech SIF, so the Sustainable Investment Forum, that just focuses on all things sustainable finance, just to build that stakeholder dialogue and figure out what, for example, a sustainable finance strategy for the Czech Republic could look like, because it needs to be in complete synchrony also with public policy, industrial policy, and so on and so forth. So in that sense, you can't just put it on a central bank or commercial banks or somebody else to sort it, because it's a bigger issue. We have some more questions, so I'm just going to quickly turn to Mr. Ristoy. We also are running slightly out of time, so let's try and remain very concise. So we have one very actually interesting question, I think, for the region in which the capital markets are not the most developed. So the question is, it's a statement that smaller financial institutions are not that interested or capable to talk about sustainability topic. That rings true, because I think as part of the conference outreach, we contacted over 4,000 stakeholders across the region, and a shocking amount of them told us that we don't really understand it, we're not comfortable talking about it, and we're going to listen in, but coming in person, that is terrifying. So what are the tools that supervisors could use to actually motivate smaller financial institutions also to think about sustainability or climate risk? Please, Mr. Ristoy, we'll start with you.
I mean, when we talk about actually what, say, regulators could actually do in what respects, regulators in the broad sense, including also supervision, can do, I don't know, why they should actually be interested in this particular topic. I think our view here is that this should be under the core mandate. This is basically tied to preserve the safety and soundness of financial institutions. It's not about actually sort of adopting other more general responsibilities in the area of fighting climate change. That should be left to governments. It's about actually just to try to understand better the implications of climate development for the safety and soundness of individual financial institutions, but for all financial institutions. The same if we actually impose some sort of capital requirements to all financial institutions, for instance, or banks, whether large or small, actually the same should be the case if we decide to adjust those capital requirements or prudential requirements more generally to incorporate actually implications of climate-related financial risks. But of course, it's true that when we apply prudential requirements to different types of financial institutions, typically we apply the principle of proportionality. This is done in different ways in different jurisdictions, but it's true that there is some possibilities actually to use simpler, for instance, formulas to calculate, for instance, risk weights, that sometimes actually we don't conduct a stress test for every single institution on an annual basis, but we concentrate on large institutions sometimes. So that idea of proportionality should also be applied actually for smaller financial institutions. But in terms of awareness, I think it is the role of regulators to make sure that in the risk management strategies of all institutions subject to prudential requirements, they have sufficient awareness of the implication of climate developments for their own risk profile, both physical and transition risks. So it's the regulators, through their particular supervisory review process, as I said before, that they should actually sort of work with institutions for the institutions to be able actually to incorporate all those relevant considerations in their own risk management strategies. That should be done. Naturally, again, applying the principle of proportionality. We are not going to require the same sort of granularity in terms of the exposures that small financial institutions have to different types of counterparties. Maybe we can do it for larger banks, but not for smaller banks. So we can adjust a little bit the techniques and the tools, but the objective should be the same. Because if we care about the safety and soundness of all institutions subject to prudential requirements, we should also care that those institutions all have sufficient ability to assess and address the implication of climate developments on their own risk profile.
Thank you, Mr. Ristoy. Actually, that's an interesting question that just popped into my own head. So I'm going to use the moderator's privilege and just jump to it. So in the sense that we discussed that we need better understanding, better knowledge, better data. So it's all linked. So do you see a role for the central bank to act potentially together with academia research? Because of the position of a central bank, the capacity to maybe generate useful data, hopefully, is there some sort of space where there should be, I don't know, better collaboration to understand the risk for climate-related risk for the financial stability, and just to warn the governments? Because in terms of just like with demographics, if you know that, and Latvia has quite a demographic issue, and Italy does, and so on and so forth. It's a big European question. So, for example, there have been a lot of warnings coming from the central bank saying we need to do something. And of course, central bank is not the one to solve demographics. It's on the government. So could it be also something similar, that the role is just to research, just to warn, and act as an intellectual hub to inform potentially public policy? And then it's up to somebody in politics to decide whether it's for them or not.
Is it to me the question?
Yes.
Okay. No, I definitely...
Actually, it's to all the panelists.
Okay.
I'd love to hear your thoughts.
Because you ask about central banks, and it seems to me that I'm the only central banker here. I definitely think that the economic community should do more of research in this area, more research in this area, definitely. If it should be central banks, might be as well, you rightly say that central banks are generally a kind of leader in economic thinking and they have the resources. But there again, it really depends. We are a relatively small central bank with plenty of competencies. And if I might be a bit politically incorrect, our impression is that, and we are many central banks in the European Union, and we see some of our colleagues who do not have so many competencies as us, have almost a similar size, if not they are bigger than us. And we also see that these central banks have plenty of resources putting in these other areas. So I think that someone should do it. We probably would not be the leading institution, not only that we might have or not some, let's say, ideological or whatever problem with that, we simply do not have the resources. The same, by the way, applies to the central bank's digital currency. We are, in many areas, imitator of someone else. But that the economics community and part of this is central banking community should do more research of this kind is certainly true in order to understand better what the risks are, what the consequences are, exactly as with demographic changes. Demographic transition has enormous consequences for financial stability, monetary policy, etc. I think we have quite a good understanding, though recently there was a bit of revolution, at least for me, in the impact of demography for monetary policy as well, because for a long time we thought it is anti-inflationary. A new book now 2 years old by Mr. Goodhart and Pradham showed exactly the opposite. So you sometimes have new ideas in this, and why not doing such research also on all possible risks, including climate change? I would be all in favor, but I'm not sure if we are able really at the Czech National Bank to be the leading institution in this topic.
I mean, that's very fair, because that would be amazing if the Czech National Bank was the world leading organization of research. I mean, that would be truly revolutionary. Sorry,
but locally, I think that is important to take part and participate with some research capacity as well. As I said, we have this green lab established as the discussion platform, and of our central bank taking a part also here with some kind of their data, their research already. And I should say also, being small, we as the supervisors and the central bank as well, we have gathered some kind of enthusiastic people, enthusiastic people who want to that, who are really into that. Besides their direct responsibilities, they are more like on volunteering to have this this topic brought up and discussed. And actually what I see, those green lab platforms as the discussion platforms, they help a lot, because different parties comes in and they do start thinking about what's my role in that, what should I do, and again about those small steps. And I should say, and even we also are inviting also other NGOs and also different kind of organizations, sectoral ones, and I think we need to raise awareness first, and the central bank with data and participation definitely are one of key players there.
I like that message. It's not just research, but it's the convening power, because when a central bank or a supervisor calls, people usually tend to answer. Martin, your thoughts from a different part of the system?
My feeling is that definitely the climate risk, let's say, research needs to be somehow connected also with financial institutions and central banks, because it's definitely connected with the climate risk and it will impact the financial risks. When we had our initial thoughts at KPMG a couple of years ago about impacts of climate risk to the institutions, to the financial institutions, to the financial market, one of the ideas was that now we are connecting two different worlds, like finance world, where we have mathematicians, economists, IT people. And now there is a climate world, and which was up to now was a completely different world. It was like more everybody feels it's activists, it's complete scientists somewhere hidden in the laboratory or in the forest. And now everybody must extend its teams. I think we can see it right now that also banks, the large banks, are also looking for new people who understand more climate, who understand, I don't know, global warming, energy systems, and so on. And these experts were never seen in these institutions. And probably this will be the similar for the National Bank to extend the team, find someone different than just pure economists and mathematicians. And that's why if you have a specialist, you do research, and that's it.
I think that's a very interesting point. We had some side conversations during the conference where we discussed how very different your mindset is depending on your educational and professional training. Yeah. It's very interesting that we have some sort of shortcuts and pathways in terms of how we see the world, how we analyze the problems. So that's a good point about having a little bit more expertise. In one of our previous projects, we discovered we did 170 consultations globally on one particular topic, and we realized that while the scientists and the real experts on the topic were here in terms of their understanding and where they thought we need to get, and then the financial sector and investors were in a completely different universe. That's how big the gap was. And it was actually very surprising because there was just no connection. It could have been completely two different worlds. So I think that's something that I think we're, I guess, realizing that the world's a bit complex. So we have 5 minutes left. So you have, I would say, 1 minute left just to quickly give a quick message, I guess, send a piece of advice to our audience, or to, well, which are, from what we can see, a lot of decision makers in finance and investing. So what would be your one kind of key advice to the financial sector for the next decade? I know it's not a simple question, so you can take a few seconds of thinking, but what would be kind of your one piece of advice, one big thought that you would like to leave the audience with? And we'll start with you, Mr. Ristoy, because you are projected onto this huge screen, so I think it's going to be quite a powerful starter.
All right, very good. If I only have 1 minute, probably, more than referring to financial institutions themselves, let's talk about the financial sector together, in particular the financial authorities. I think it's clear that financial authorities, regulators have a role to play, but we have to understand actually what that role should actually be. So let's actually concentrate on the mandate. Mandates should not be changed for the regulators, but of course they have to embed or they have to develop ways to address actually implications of climate developments for financial institutions themselves. And that is a combination between actual guidance and maybe rules, eventually requirements, with the provision of some sort of services that could help the banks themselves actually to develop their own transition plans, to try to modify the risk management strategies to cope with these very important developments. So it's not only about guidance, it's not only about rules, but it's about facilitating actually the know-how. It's facilitating in particular actually the right taxonomies, the right scenarios, something which is already actually undergoing in the international community, for instance, by the role played by the Financial Stability Board in terms of disclosure, or the work conducted by the NDFS in what respects scenarios. So that's the idea. This is important, but everybody has to understand well what the role is and try to implement that role actually with the right combination of requirements and on the other side actually support that they should support, that they should actually convey to the regulating institutions.
Thank you, Mr. Ristoy. So know-how and improvement of the know-how. Mr. Mora?
Very quickly, as you know, the inflation in the Czech Republic is very high, so be assured that we will bring inflation under control. It will take us some time. This is the responsibility of the Czech National Bank, and I'm convinced sooner or later we will do it. As for climate change, I'm convinced that the mankind will also resolve this issue. However, there I would not rely too much on central banks.
Thank you, Santa.
So yeah, I believe that the ESG risks, they will remain, and they will become one of top topics in everyday's agenda for everyone. And I think we start to act now. We are, as I said, we are talking with, in an open dialogue with all banks we have. And actually with that, I want to say once again that we need to start quicker rather than later. And also, I think we as a supervisor, we would love to use our supervisory tools afterwards more in a carrot type of manner rather than the stick type of manner. So definitely I'm looking forward that we will gain more opportunity out of that rather than just the risk.
Perfect, thank you. Martin?
Maybe I have better than recommendation. I have some point to think about. This is what I have been thinking for the last couple of weeks, is that maybe the climate risk, it's not so far as we think currently, especially one component which is transition risk. Typically, it's like the horizon is 2050, with the Paris Agreement, European net carbon 2100 with lowering the impact of global warming. But when you look at the current situation with the Russian invasion, you can read everywhere, we need to do something. We need to, let's say, change our energy consumption, energy strategy, and this needs to be done. I think there is some European program right now by 2030. Mm-hmm. So probably we will, let's say, see some case study of transitional risk for, let's say, 8-year period. I think it will be very interesting for Czech Republic, which is, let's say, I think top 3 carbon intensity leader in the European Union. So message is maybe we will see how this will evolve, and we need to sustain also in those activities we are doing, and I think this will bring us new discovery.
Thank you very much. I think that's our time up. I think it's very interesting that you mentioned that, because there's the UNPRI inevitable policy response. If you look at their scenarios and their estimates, then actually even under their estimates, the inevitable transition risk is much earlier than most people anticipate, because some countries with the pressures from society might start acting, and it then trickles down through the supply chain system, and it really can harm countries that are maybe left further behind. So I think that the main message here is that we do need much more research, we do need much more data, it's a much more collaborative effort, so we need to work and talk to each other a lot more, so we hope that we will be able to do that going forward, and that we need better tools and information to navigate the complexity to make actually just better and more informed decisions going forward. And with that, thanks everybody, and we will see you again tomorrow for sustainable innovation. Thank you.